Hi, everybody. Good day. This is Louis Johnson, the CIO at Capital Wealth Advisors, and I'm here with our latest edition of 3 and 3, which is where we try to show you three things that we think are interesting and noteworthy in the markets in 3 minutes. So here we go. So today I wanted to highlight a piece of research sent to me by my old friend Barry Bannister, who is the chief strategist at Stifel. I've known Barry for more than 20 years. He's one of the most brilliant creative thinkers in the market. It's my great pleasure to call him a friend. So let me outline here something very important that we're looking at. And this displays one of our key takeaways, which is that we do believe that we're beginning a very long period of outperformance of kind of commodity-related equities relative to large cap equities. So let's talk about it. Barry, as a long-term strategic thinker, goes all the way back to 1990, basically shows 120 years that shows a ratio of two things. This is the ratio of large cap US equities, in this case the S&P, relative to the total return on commodities. And what Barry demonstrates here is there's been 1, 2, 3, 4, 5 times when we've had a change in leadership from large cap equities to commodities. This seems to be the fifth one, as Barry was outlining here, from a very high level. This is a conversation I had Barry for a while, and I do believe that he's correct, that we are in a transition period that is leading to long-term commodity leadership. We're very excited about this. We think this is the most important thing in the world over a long period of time. That's our first thing. All right, here we go. Number two. All right, this is that same long-term commodity chart in terms of long-term rolling returns. In this instance, which is black, this is also from Barry's report. What is here in red is something you can see is quite similar in terms of the relationship. And what this is the long-term returns of the value stocks versus growth stocks. And you can see that for the last 100 years, it's very, very tightly correlated, as Barry outlines here in his wonderful report. The other point that I'd like to highlight is we're starting from a very low level here. And in the past, this has worked 8, 10 years. And the cumulative returns, as Barry indicates here, are 11 to 13% annualized over a 10-year period. This is another cycle that we are very early in the phase of, we believe, and we're super excited about this. So there's a lot to be excited long-term in these markets. Third part, which is really kind of long-term optimism, short-term caution. So here, one of the things that we wanted to highlight that why we are a little short-term cautious. This shows the ratio of the this is the gold price divided by the S&P 500. And what we demonstrate is there was a long period of time of gold doing well. There was a long period of time of gold not doing well. But I would argue gold relative to the S&P is broken out. We think we're very early in that phase. You can see this is essentially a 10 or 11-year down cycle that's changed in just recent days that's shown strength. While we think this is wonderful for gold and commodities in the long run, this is a sign of kind of higher risk in the marketplace. And so this is the last thing that I wanted to share with everybody, basically, is that we think we could kind of see a surprise why we are currently positioned conservatively, we think, in the market. Is so what I believe that we could see in the back half of the summer is not only strength in gold as a defensive asset, but also higher quality, longer dated bonds. And let me tell you why. So basically, if you take a look at two things, don't take my word for it, go read these. Roy Jastrom's Golden Constant in 1976 and George Warren's Golden Prices in 1935 show one important thing if you'll study it, and that is that the relative value of gold goes up in a deflation, in a slowdown. And what this demonstrates, in my opinion, this right here is a color gold. This is a long gold short commodity or gold relative to commodities. You can see that it's come down quite a bit as we've had a pretty big inflationary shock that's taken place as Mr. Putin has rolled into to Ukraine. But the other thing I wanted to demonstrate is how closely this is correlated with the white line, which is the long-term price of kind of U.S. government 30-year bonds. Here is displayed by the TLT. So what I wanted to demonstrate is that major lows in terms of gold's relative value to commodities, you can see that here, there again, of course, and the highs are very similar as well. And we think this is frankly an important low right here if we are correct that the economy is kind of decelerating in transition. So basically what we want to do, final takeaway, is that why we have tremendous long-term enthusiasm for commodity-related investments. We do believe that this summer should be a period of slowdown. And you've got Mr. Powell raising interest rates pretty hard at the Fed. We want to be cautious for this period, and we're positioned for that. because what we're playing for is a wonderful opportunity that we think is going to be a multi-year period. But we do want to go through this this kind of short-term rockiness. There are things that we'll be watching. We've outlined some of these indicators, and we'll be talking about them in the future as we go through in future 3 and 3s. So I wanted to thank everybody for the time. Peace out.